Over the next week, stock regulators and Wall Street are expected to complete an industry-wide settlement that will change the way investors get information about stocks and will change the way stock analysts get paid. Now, while some aspects of the agreement could change, what is on the table now and how will the settlement affect investors? Joining us from our New York City bureau with some answers is securities attorney John Lawrence Allen. John, good to see you. Good morning.
Hello, Ted. How you doing today?
Good, thanks. Look, for starters, who's involved here?
Well, involved with regard to the regulators, of course, Mr. Spitzer from the New York Attorney General's office, the New York Stock Exchange, the SEC, and NASA, the North American Securities Administrators, all have combined to try to get this global settlement regarding most of the named brokerage companies across America.
All right, what are the talks about specifically?
Well, as has been revealed many months ago, Mr. Spitzer entered into a settlement with Merrill Lynch for $100 million regarding emails that were sent regarding investment banking and analyst reports. And at the core of this is whether, in fact, investment banking and analysts were tied to one another, so that the brokerage firms were allegedly providing tainted analysts or analysis of stock and research reports so that investors didn't get what was supposed to be independent and unbiased research.
All right, so what's the settlement really mean then for stock research?
Well, the proposed settlement, if it goes through as proposed, is going to break apart the investment banking from the analysts. That means that in the old days, analysts could go to what was called pitch meetings. That means that if an investment banker is trying to get a deal or trying to woo a client, they'd bring an analyst, and possibly an analyst might write a biased or a favorable research report so that the investment banking side could get that client. It could mean $40, $50, $100 million in fees. If the settlement goes through, analysts are no longer going to be allowed to go to these pitch meetings, and the investment banking arm is going to have to be separate so that you get unbiased, independent analysis.
What financial penalties will Wall Street pay?
Well, they were looking to try to get $1 billion. Now the talk on the street is somewhere between $500 million, maybe approaching $800 million. And they're using the Merrill Lynch settlement as a benchmark to try to bring down the amount of fines and penalties that each of the brokerage companies are going to pay.
What about restitution for people like our viewers, investors?
Good question. The Sarbanes-Oxley bill had talked about a provision in it for restitution, and the SEC has the power to set aside a restitution fund, but that becomes an administrative issue. How do you deal with it? How do you have criteria for investors to verify that, in fact, they were defrauded? So while there might be part of these fines going to restitution, the process of how if an investor would go back and get those monies has not been really set in concrete yet.